Hey, today we're going to look at a ratio that might be able to tell us whether stocks are going to be able to keep their bullish posture in the sort of, let's say, Q1 to maybe Q2 period of 2022. And so, a very simple way of doing that, and a very effective way, I should say, as well, is by looking at sort of risk on stocks, which at least some of them, or a good part of them, are consumer discretionary stocks. You could call them those a bit more cyclically exposed to the economy, meaning if the economy does well and people spend money, they'll tend to spend money with cyclically sort of sensitive stocks, meaning consumer discretionary stocks. And what you'll notice if you look at this chart here is that this sector, the consumer discretionary sector, the XLY, has, after a nice run up from October, has now, as I'm recording this, retraced about 8, actually a bit more. It actually retraced about 12%. Currently, as I'm recording, it's down about 8%. So that's a pretty meaningful move back. At the same time, money has been flowing into sort of so-called consumer staple stocks, and those are the companies like Procter and Gamble. Meaning, if the economy doesn't do well, people are still going to buy things like toothpaste. At least I hope they would. No, all jokes aside, that's the kind of stuff that people would continue to buy. And maybe buy a bit less, consumer, again, cyclical stuff. So as a result, we've seen, obviously, as I showed you before, the consumer discretionary stocks coming down, consumer staple stocks having a nice rally. In fact, they had a nice breakout move. Now, what's important and what I want to show you is the ratio between these two. And if I just take these two, I'm going to take the XLY, which is consumer discretionary, and I'm going to divide it by the XLP, again, consumer staple stocks. And if you look at this, you can see we've actually retraced right back to a level of previous resistance, and maybe this area, and then it's an area you draw these lines with a crayon, not with a pencil, is kind of support. And so basically the way I look at this, very simply, is first of all, you want to make this something like a weekly chart. This needs perspective. This is not an immediate gratification call. But the question now basically becomes whether the check back that we're seeing here is simply that it's going to find support on the ratio, right? And if that is the case, then consumer discretionary stocks should be able to outperform again. So then that would be like, this previous breakout here that you saw in May of 2020, whether, it's this kind of a move, it's simply a check back to this levels and then we go higher, or it's something more sinister or just more mean reverting, where consumer discretionary stocks are going to more meaningfully underperform versus consumer staples. And so one way of looking at this is you can even make this, if you want to take this to another level of sort of complexity, and I mean this in a good way, you make it a logarithmic chart, which gives you a bit more perspective. And you even look at this on like a monthly basis. So really zoom out. And when you do all of that, you can see that consumer discretionary stocks versus staples have had one hell of a move, right? And so if you then take that and then you go back and do the same chart, the same sort of the same time frame, meaning monthly charts, and you look at it from a logarithmic perspective, what you then see is that even though consumer discretionary stocks have been outperforming, right, consumer staples have had a really big up move as well. So the XLY, just to juxtapose this, also has been in a stable uptrend, just more sharply so. It's not that consumer staples haven't been going up. They've just been going up at less of a rate of change. And so all of this brings us to a point where this ratio that I showed you here, XLY versus XLP, is, in my opinion, a really important one. Well, you can even turn it upside down and look at XLP versus XLY. So now it's basically you flipping the former numerator to the denominator to the numerator. And you can, if you're more sort of inclined to look at bullish charts, it's the same exact thing. So here now, what you want to look for is whether consumer staples versus discretionary are able to break higher. It's the same chart, just the upside down. So this is a ratio that we're watching very closely. It's a simple thing to watch, but it is effective, and we want to see if this holds. If it starts breaking below, some of these simple trends here, then this may be a sign of more broader risk off. So a very simple way of looking at markets from a whether they can continue to rise from a So from a bullish posturing perspective broadly, or whether we go into a more prolonged choppiness and maybe even somewhat downside cycle, which quite frankly at this point does look like it may be the case in the first half of 2022. Hope it helps. We'll see you again in the next video.